Probably the reason why, Steve, markets are holding up the way that they are right now and not indicating crashing. But, Diane, if you look at some indicators out there, like yield curves and spreads between long-term and shorter-dated bonds and notes, it does indicate perhaps that things are due for a bit of a pullback and not just a normalization. So is the data suggesting right now that we could be seeing more signs of that, but to Steve's point, that it may not just be the dire economic situation that some are forecasting for?
Well, I think the real issue is the economy's been remarkably resilient. And in the face of that resilience, the Fed has sort of doubled down, even through financial market fragilities and additional tightening in the pipeline, that they're going to continue to fight inflation and sort of try to divorce the idea of rate hikes from financial stability tools. And the two are intertwined. You can't just divorce them. The breakup is not easy. And I think the real risk now is we've upped the ante that the Fed overshoot. I think another important issue for the Fed is a research study just came out from the Kansas City Fed that looked at the service sector, that it's much less interest rate sensitive than other sectors, particularly in employment, which means the Fed believes it has to overshoot to get to that core service sector inflation, which is so worried about. And that sets the stage for, this harder landing that Steve talked about. I call it cooling and slipping through the ice into, they don't want to send the economy into a deep freeze, but you're going to get a little more chill, I think, than you'd like. And you get a harder landing with the Fed continuing to fight inflation and the pipeline of tightening that we have in the credit system already. It's going to really hit those businesses that have been the backbone of the recovery and the resilience, and that is businesses with less than 250 employees. In those most recent job opening and labor turnover surveys, job openings among businesses over 5,000 fell yet again. It's the smaller, younger businesses that have really been the resilience, and those are the ones that are going to slowly feel a crunch in credit. And this is a sort of slow-moving train wreck, unfortunately, is how I see it.
Okay, so let's say that's the case right now. Steve, we've had a lot of conflicting data. Speaking of hard versus soft, the hard economic data, the stuff that we can measure, right, it has been showing one thing. The softer economic data, sentiment surveys, that sort of thing, in the past year have been pointing towards slowdown, recession, and none of that's really come to fruition. I wonder, though, in this case here, how those sentiment gauges are playing out right now compared to what the hard economic data is showing.
Yeah, Tom, that's a good observation. And to make that distinction, I think is really important for investors to do. Well, take the ISM services today. It fell by, it was 3 points, but it's still in an expansion mode, 51. And I don't know if you recall, Dom, earlier this week, I did the CNBC Rapid Update. What happened? Once again, the weakness was shifted into future quarters. I'm getting a little tired of this. I'll bet the forecasters themselves who we survey are getting a little tired of this. But we've been waiting for the consumer to give it up for quite a while. I know that everybody thinks of employment as a lagging indicator. But in this sense, I think it's at least coincident and maybe leading, because one of the things that's powering the consumer are jobs and wages. And as long as those remain relatively resilient, and they don't need a lot, Dom, because if you think about, for example, the participation rate is relatively high, the unemployment rate is relatively low, a lot of the population is employed, has the wherewithal to spend, and there's two factors that are going on that, to me, is a race to figuring out what's going on. First is the idea, if inflation falls, wages and employment remain high, people will get real income increases, okay? On the other hand is the thing that Diane talked about, which is a major X factor in every survey that I read, which is the credit tightening. If that credit tightening really goes asymptotic in the sense that the numbers really start to come down, then you're going to have probably a much harder landing than even the most optimistic person can expect.